Hi guys, welcome back to my YouTube channel. This is a pre-December 2024 SBR mock debrief, and this was the paper which was let out by ACCA. So if you are attending this debrief, I am sure you must have attended this mock. And if you have not, just pause this, first go through it yourself, try to solve it yourself, and then come back to this video to know what could have been your answer and the way you should have thought while solving this paper. Okay, so the first requirement, guys, I've just copied and pasted all my requirements in the response option and I've formatted them as well. So I'll read it here only. So using Exhibit 1, I'm, supposed to comment in accordance with IFRS 11, so which deals with your joint venture and joint operation, that why Christon should be classified as a joint venture. So basically, this Christon company is a joint venture and they're asking me why, and this is for 4 marks. So my first, you can say point that I can make and obviously right is that IFRS 11 talks about joint operations and joint ventures, right? Then you can tell what joint venture exactly is, where there is joint control. I'm writing in short form. Joint control exists when you basically have a separate legal entity which is being created on which two or more investors have unanimous consent. This is what I mean by joint venture. And what is the accounting treatment? Second point can be made up for that. The accounting treatment is as per IS 28, where I follow equity method of accounting for joint ventures. Okay, now here in this case, what is happening in Christian company? If you just look out, let's just have a quick reading. So on 1st July 2015, Whitecut purchased 30% of equity share capital of Christian. So when I look at 30%, it seems to be an associate. And the cost was 1.9 million. It recorded the shares as non-current asset measured at cost. So they've done nothing for this. An unrelated company, a lister company, purchased 55% of the share capital. So you have 30%, another company has 55%. The remaining 15% in Christian is held by several other individual investors. Okay. Now, documented discussions between Whitaker and Alistair state that decisions about Christian's operations, financing structure, and investments require an 85% majority. So that means you need 85% majority. So decisions can never be made by Alistair alone or a lister in combination with other investors, because 55 plus 15 will be 70%. We need 85% majority. So decisions can always be made only if a lister and white taker, they both, they have a consensus on that point. So what we can say here is just give a third point here, that there is a unanimous consent in this case. You will prove this because the decisions are made at 85% majority, so that can be considered as 55% of the voting rights of a lister and the 30% voting rights of the company that we are talking about. Okay, so this is basically company Whitaker, right? So they both own the company, Christian. So you can say that thus the decisions can never be made individually by Alistair or in combination with other investors. Because even if they collude, then the percentage voting right will be just 55 plus 15, that is 70%, right? So that's one point. So this is a unanimous consent situation. That's why Christian is your joint venture. Neither Whitaker nor Elisters have right to the assets held by Christian, nor are they liable for its debt. So on 1st July, the fair value of Christian's net asset was 6 million. Okay. So 6 million was the net assets of our joint venture. In the year ended 31st December, Christian reported profits of 1.4 million and reported gains on debt investments measured at fair value through OCI of 6 lakh. Both the amounts accrued evenly throughout the year. So they're saying that the net assets of Christon were 6 million and Christon reported profits of 1.4 million. So 1.4 million is the profit, and then there were some fair value gains via other comprehensive income of 6 lakh. Now, see, these gains are made for the year, they are not made at the end of the year. So we are supposed to time proportion them. Here, my time proportion will be for 6 months, 1.4 million into percentage of my interest into 6 by 12. Similarly, for 6 lakh, 6 lakh into 30% for 6 months. This is how I will calculate my share of investment in my joint venture. So let us try and actually solve it here itself. So we will say that the investment, or you can say as per IS 28 in SFP, this investment in associate will be shown separately as, how do you show it? It's cost plus share of profit in associate in joint venture. So it will be 1900 because 1.9 million is your cost, right? So you'll say 1.9 million means 1900. In that, you will add your share of profits. So if we just look at this, what is it? So what I'll do is I'll just go and just write here. It is 1900 plus it is the 400. Okay, so it is 1.4 million. So 1400, 30% of 1400 into 6 by 12 plus 600 into 30% into 6 by 12. So this turns out to be $300, right? So this is something which is added into the, this is something which is added into your investment in joint venture. So 1900 plus 300. So what I'll do is I'll go to my spreadsheet, which is a pre-populated spreadsheet that I'm supposed to edit here. So if you just read the requirement here for the pre-populated, they are saying using exhibits 1 and 2 and 3, your previous answers, adjust the pre-populated spreadsheet. And this is basically while solving the first 3 requirements, you have to adjust the third one as well. So while solving A, B, and C part, B1 will automatically get solved. So what I'll do here is, this is my adjustment number 1. From my non-current assets, I will remove 1900 because of course that is something which should not be here. And I will add a new column of investment in joint venture. And in that investment in joint venture, I will add 1900 plus there is an addition to it of 300, which is the share of profit in joint venture. That's my second adjustment. So this is what I do in my pre-populated spreadsheet for the first adjustment regarding the requirement A. Okay, let's move on and let's read the second requirement. The second requirement is regarding your IS 36. Explain with calculation. So explanation is required that how impairment is to be allocated in case of a CGU. So which CGU are we considering? We are considering the CGU of Kennedy. So let's read investment in Kennedy. Okay. So they're saying, let's read this. Fine. So here they are saying that Whitaker acquired control of Kennedy in 2011. So the control has already been acquired. It purchased 70% of the Kennedy's share capital, and Whitaker has identified Kennedy as a CGU. So basically a subsidiary that you have acquired, you're treating it as a CGU. Now, at the acquisition date, the fair value of the land owned by Kennedy was 1,90,000. So the net assets of the subsidiary on the date of acquisition was 1,90,000 in excess of its carrying amount. Okay, so this is fair value adjustment of 1,90,000. The land is still owned by Kennedy at 31st December. Goodwill on acquisition was this much. The NCI was measured as proportionate value. So it is like partial goodwill that you've calculated. It is not full goodwill. So on 31st December, as a result of new legislation, Whitaker conducted an impairment test on Kennedy, finding it to be impaired. Now, Kennedy has been included in the draft consolidated financial statements in accordance with IFRS 3. The value in use of Kennedy was 3.8 million. So that's the value in use, and fair value less cost to sell was 3.85. So you will keep 3.85 as your recoverable amount because that is higher of these two amounts. The measurement of value in use and fair value less cost to sell excluded cash flows associated with current liability and current assets and total liabilities. That's the right thing to do. You do not include these. Then Kennedy's assets and liabilities are given to you. So this is your CGU's current, non-current assets, liabilities, and everything. So now what you are supposed to do here is that first of all, you need to identify the fact for 10 marks. First, you'll talk about what an impairment is under IS 36. You'll explain what impairment is, reduction in value of asset. Okay. Then you will tell them that what a CGU is. CGU is the smallest group of identifiable group of small assets which can generate independent cash flows. And then you're supposed to tell them that how do you conduct an impairment review? You take your asset to lower of cost and NRV, or you can say and recoverable amount. And then you can say recoverable amount is higher of value in use and fair value less cost to sell. Then you can tell how do you allocate your impairment. Impairment is first taken via statement of profit, and if there's a related revaluation surplus, you first take it via that, and then you take it via statement of profit and loss. In case of a CGU, how do you allocate the impairment? You allocate the impairment on the basis of, like, first you allocate it to the damaged asset, then you allocate it to the goodwill, and then you allocate it to the other assets on pro rata basis. Make sure that you exclude current assets from this particular thing, right? And if I talk about in this situation, what all assets is this CGU having? Financial assets. See, it's a very great point to mention that financial assets impairment comes under IFRS 9. So that does not come under IS 36. So you will say in this case, the financial instruments are not impaired as per IS 36, but as per IFRS 9. So this will be done as per IFRS 9, not IS 36. And then what we have is, okay, then you can just simply mention that when you, where you've written about the higher of fair, value in use and fair value less cost to sell, you can say therefore the recoverable amount is $3.85 million. And let's just conduct the impairment for this now. Okay. So how will we conduct the impairment? Let's not forget that this is partial goodwill. So this is partial goodwill. And to make it comparable, I need to apply the concept of total notional goodwill. So I will have to gross up the goodwill. So how will I gross it up? I'll say, what is the carrying amount of the CGU? The carrying amount of the CGU is given to you, like, you were given the figures here. So the total that you have to take is this one plus this one, okay? Non-current assets of total which are given to you, the 3760. So 3760 is taken. In that, you add your fair value adjustment of land, which was 190. Okay. And then you gross up your goodwill. So what was your goodwill? Just look at it. They've said that the goodwill on the acquisition date was 3,18,000. So gross it up. What would have been my goodwill? Use unitary method. See, the NCI in this case was 30%. So if 70% of goodwill is 318,000, then 1% will be 318,000 divided by 70%. And if I have to calculate 100% goodwill, the grossed up goodwill, it will be 318,000 into 30 divided by 70. So this comes out to be 1 lakh. Okay. So this comes out to be, okay, the notional goodwill comes out to be, it will be just, let's go to the calculator. We have a calculator here. So it is 318,000 into 30 divided by 70. Yeah. So this comes out to be 136,285. So 136,285, that is basically the notional goodwill, right? So this is, I'm calculating the 30% here, not 100%. So this is the 30% notional goodwill of 136. So what is my total notional goodwill? My total notional goodwill is 136 plus the original one of 318. I'm working in thousands. So this is something that is my total notional goodwill. So I will just add it to my carrying amount. That means I will add 136 and 318 to it. So I get a total carrying amount of $4,404 for the CGU. Now, what is the recoverable amount? Recoverable amount was higher of value in use and fair value less cost to sell, which was 3.85, which was 3,850, right? So 3,850 is my recoverable amount. So what exactly is my, the impairment? So the impairment loss comes out to be, if you just calculate this impairment loss, this is coming out to be 5,54,000. So this comes out to be 5,54,000. So you can just again just look at the calculator. It is 4,404 minus 3,850. So just clear it all. Okay. So it is 4,404 minus 3,850. Yeah, so 554. So this is coming out to be 5,54,000. And this is my impairment loss. Now, how will I allocate this loss? So let's calculate our allocation of impairment. So first, they have not given us any damaged asset, so I'll completely allocate it to my goodwill. So first, I will allocate it to the goodwill. So the loss, the total goodwill that has been reported is 318,000, right? And I will allocate it completely to 318,000. So that gives me a zero goodwill. Now, what is the unallocated balance? Let's look at the unallocated balance. Okay. So let's find it out. Fine. So this goodwill 318,000 was the goodwill of just 70%. I need to add the 30% into this. So my total goodwill was 318,000 plus 136,000. That was the notional goodwill, which comes out to be 454,000. Now, out of the 5,50,000, I have allocated 454,000 impairment to goodwill, which gives me zero goodwill. Now, the unallocated balance is 5,54,000 minus 4,54,000, which comes out to be dollar how much? This is to be okay. So this is 554 minus 454. So this is $100 which is left to be allocated. Now this $100 needs to be allocated to other assets on pro rata basis. So what are the other assets? I'm not going to impair my financial asset because that is IFRS 9. So only PP and intangible asset. So what I will do is I will calculate my impairment like on pro rata basis. So I will say first allocation is to PPE. So the PP is actually given to me as 2,233 plus 957. So the total is 2,233 plus 957, which is 3190. So I will say the PPE's allocation is just a working a random. So PP's allocation is 2233 divided by the total 3190 into 100. So allocation is 70. Then for the intangible asset, the allocation will be how much is this? Okay, we forgot one thing. They have also given you some fair value adjustment. So add 190 to your PP. Let's not forget that. Okay. So this is your new number. So what is the new PPE now? The new PPE is 2233 plus 190. Okay. So plus 190. Yeah. So 71.6 is the allocation of impairment to the PPE. For intangible asset. It is 957 divided by the total amount into 100. So that is 28. So 72 and 28 basically. So let's write it up here. The unallocated balance, PPE. So we will say in PP, there is a fair value adjustment of 1,90,000. Let's not forget that. And after that, the PPE's share of impairment is 72. And intangible asset share of impairment is 28. So this is what we will do in our pre-populated spreadsheet as well. You can just delete them off and do a proper calculation on your word processor. Okay, so I hope you've understood the calculation. Now you will just simply adjust your pre-populated spreadsheet as well. So here what we are going to do is there is an impairment and let's come to adjustment number 3. So first of all, the impairment is going to happen from non-current assets. So the impairment of total, non-current assets are given as 1. So we will deduct 100 from here. Then from goodwill, we are going to deduct the amount, which is, what was the goodwill amount that was being impaired? 318. Because the notional goodwill was anyway not recorded. So 318 is what is the allocation of impairment. So that's what we do for our adjustment. Then what else do we do? This is your total adjustment of which happens to the impairment. Now we have to allocate it to the parent and NCI. So what is the parent's share in this? And what is the NCI share in this is what needs to be calculated. So if you look about the NCI has 30% in it. See, NCI will not have a share in goodwill's impairment. So the NCI will only have a share in the, impairment of your non-current assets. So that is 30, which needs to be deducted from NCI. Then what needs to be deducted from group retained earnings? From group retained earnings, the whole impairment of 318 needs to be deducted, plus the remaining 70 of what we have from the impairment of non-current assets, which is 388, needs to be deducted. So this is what we do for our adjustments in our pre-populated spreadsheet. So you will just say here, you can even mention a point. The ninth point that you can mention, that the impairment of PPE and intangible asset is allocated to NCI as well, but the impairment of goodwill is not allocated to NCI since the goodwill was proportionate goodwill. That's it. So this is what we will mention, right? That completes our 10 marker. Then they said, explain with calculations how Whitaker's purchase of additional equity share capital in Freeman should be reflected in consolidated financial statements. Let us see what's happening here. Now, Whitaker acquired control of Freeman on 1st January 2012 when it purchased 60% of the share capital. At this date, Freeman's recognized net assets in its individual financial statements were 1.58 million. So on the date of acquisition, the net assets of the subsidiary are given. And Freeman had not recognized a brand name in its individual statement, which had a fair value of 2 lakh. So we have not recognized a brand name on 1st January and an estimated useful life of 20 years. Now the NCI at acquisition was recognized at its fair value of 8,50,000. So on 31st December, when the net assets of Freeman had a carrying amount of 2.42 in its separate financial statements, Whitaker acquired further 30%. So it is a step acquisition movement where we are moving from control to control. So you need to first identify this fact that we are moving from control to control. So see, the identification comes as this is step acquisition when we are moving from control to control, right? And what happens here is because of this NCI reduces, which means no goodwill, recalculation, or no profit or loss on disposal. Then third is that this is something which is going to lead to a journal entry that when you acquire something, NCI is reducing. So NCI debit, bank credit, and the balancing figure goes to other components of equity. The amount with which the NCI is reducing needs to be calculated. So how we are going to calculate that? Let's see. See, we need to first see what was our NCI at acquisition date. So we will take our NCI at acquisition date. Okay. Then if there was any NCI share of profit from acquisition till date, then what we can take is how we will calculate that. That depends upon the information given to us. And then finally, we will get our NCI at the date of acquisition. So let's see what information is given to us regarding NCI. Here they're saying that our NCI was Freeman had not recognized the brand name. Okay, so NCI at acquisition was 8,50,000. So our starting point is 8,50,000 NCI at acquisition date. Then on 31st December, the net assets had a carrying amount of 2.42. So that means your net assets have went up from 1.58 plus 200 to 2.42. So that is the movement in net assets since acquisition. So NCI will have a share of profit in that. Then Whitaker acquired further 30% interest in equity share capital of Freeman for a consideration of 1.25. Whitaker prepared the draft consolidated financial statements to include Freeman as 60% owned subsidiary. In accordance with relevant IFRS, it has made no accounting entries in relation to purchase of an additional 30%. So that's wrong. So we need to correct that. Now see what you will do. You will calculate that what were your net assets. How will you calculate NCI share of profit till date? See, your starting point is 850. NCI share of profit in net assets since acquisition. How will you calculate it? For that, you need to see what were your net assets. So what was the net assets of the subsidiary on date of acquisition? So they are given to you that on date of acquisition, it was 1.58. So it was 1580 plus there was a $200 fair value adjustment. So that gives you 1780, right? Then what are the net assets of the same subsidiary at this point at reporting date? How will you calculate it? See, they've given to you again. What is your, okay, just look at it. They've not directly given you the NCI, but they've said that on 31st December, the net assets of Freeman had a carrying amount of 2.42. So on 31st December, it is 2.42. So if I have to look at that, so what is it? 2.42 means, I'll just simply calculate that this is basically, yeah. So this is basically 2.42, 2420. This is basically my net assets at the reporting date. Now, what they are asking you here is that what was the increase in net assets? What was the increase in net assets? Let's see. Just read it again. So on 31st December, the net assets of Freeman had a carrying amount of 2.42 in separate financial statement. Uh, Whitaker required further 30% for consideration of 1.25. So in separate financial statements, the net assets of the subsidiary were 2.42, right? So what is this? This is a movement in net assets. This is an increase in net assets. So how will I calculate the percentage or the amount of increase? The net assets at reporting date will not be just 2.2420, but also the 200 which was added at the date of acquisition needs to be adjusted. So this 200 is here. And if you just look at the number of years that have passed from 2012 till 2015, so it will be approximately 4 years, and the life of that asset was 20 years. So I need to account for the additional depreciation as well. So I can say the net assets of 200 have been depreciated. So its carrying amount will be 16 divided by 20. So the net assets at the reporting date will be approximately 2580. Now, what is the movement in net assets since that date of acquisition? Movement in net assets of the subsidiary will be 2480 minus 1780, which is $800. Now, this 800 is the increase in net assets. So, what will be the NCI share of profit in that? So, NCI share will be 30, it will be how much percentage the NCI is of, if you look, it is 60% that is purchased. So, 40%. So, my NCI will be 40% of 40% of this 800. So, my NCI will be 40% of 800, which is 320, right? So what is my NCI on the date of reporting? So NCI at 31st December is coming out to be 850 plus 320, which is 1170, right? So 1170 is my NCI at 31st December 2015. Okay. Now what they are asking you here is that on the same date you've purchased extra shares. So when you purchased extra shares on the same date, what are you going to do? How will you calculate your reduction in NCI? You will use unitary method. You will say if your NCI is reducing, right? Your NCI is reducing by a 30% figure. So you will use unitary method for the calculation of reduction in NCI. You'll say if 30% of, if 40% of NCI is equal to 1170, then 1% is equal to 1170 divided by 40. I need to calculate how much is the 30%. So 1170 divided by into 30 divided by 40. So that is basically my decrease in NCI, which is ultimately coming out to be 877,500. So if I work in thousands, this is what it is coming out to be. So 877,500. So basically coming out to be 877.5. So I added 2 zeros in front of it. So what will be my journal entry now? As per this, my journal entry will be NCI is decreasing by 877,500, and the money is going out by how much? The money is going out by 1.25 million is the consideration. So money is going out by 125,000. Okay. So money is going out by 125,000, and NCI is reducing by this much amount. And this amounts to what? This is a gain or a loss? 1.25 million. This is basically a, okay, million means I need to add, yeah. Now this amounts to a loss. On my debit side, there is a balancing figure. So here there will be other components of equity debit. The balancing figure is coming out to be 372,500. Now, this is what they have not recorded, and you are supposed to record it in your pre-populated spreadsheet. So what we'll do is we'll go to our spreadsheet and make an adjustment to it to account for this. So what I'll do is I'll first of all that 1250. Just look at it. They've given this 1250 here. We need to remove it from here because it's a subsidiary only. So there's no need to increase your asset by 1250, right? And then what we are going to do is we are going to effect our, the journal entry that we have passed. So we need to reduce our NCI by this amount, and we need to reduce our other components of equity as well. So NCI will reduce by your 877.5, and your other components of equity will also reduce. So put your other components of equity over here. So let us put other components of equity here. And fine. So here in other components of equity, even the investment that you made in your joint venture, the first adjustment that you made, the part of it was related to other comprehensive income, if you remember. So 600 was out of it was related to other components of equity. So that was like 600 into, it was, the percentage was 30% into 6 by 12. So that was going, 90 was going into OCE. So let's post that also. 210 out of 300 was here, and 90 was going into OCE. So I forgot to do that for the first adjustment. And the other part of OCE here is reduction because of the loss. And that loss is because of the Freeman investment, which is of 372.5. That's it. So these are the adjustments that you were supposed to post in your pre-populated spreadsheet to get your full marks which are available. And this is something which is difficult, especially the allocation of this loss of, what you allocated to retained earnings and OCE. So here in the, joint venture, there was a 300 profit that, allocated to joint venture, but that has to go to retained earnings by 210 and 92 other components of equity. Because when we read the first exhibit, they made it clear that 600,000 was fair value gain, which went via OCI. So yes, this is to go into other components of equity only. So that's what I have done. Right? So this is how the question number 1 looks like, and it was quite easy. I would request that if you have not done it so far, please attend it once before we start with the second question.